After a truly frenetic fortnight of central bank policy decisions and corporate results, we've a slightly quieter schedule ahead of us in the coming week, but it should be no less informative for that. As can often be the case, the macroeconomic highlights may come from the far side of the Atlantic, with a pair of data points that are due out on Thursday, the 11th of August. These should both be viewed in the context of a 4-decade high in inflation, rising US interest rates, and second quarter GDP data, which technically put the US in a recession, as the American economy has shrunk for 2 straight quarters, at least based on preliminary estimates. The first figure to watch is US weekly unemployment claims. The long-term chart suggests there's nothing to worry about at all, as weekly claims last came in at 256,000, miles and miles and miles below the dark pandemic-ridden days of spring 2000, and indeed nothing like the high seen during the recessions of 1991, 2001, or 2007-9. But zoom into just the past 12 months, and you can argue the picture looks a little bit different. Weekly unemployment claims bottomed at 166,000 in March, and have since risen by some 50%. Again, the overall numbers are still low, but the trend is not an encouraging one given the first and second quarter GDP numbers. Maybe the US economy really is slowing down, and that may be why the Biden administration will be relieved to finally get the $280 billion CHIPS Act and $369 billion Inflation Reduction Acts passed. Although, how more stimulus can lower inflation is a matter for another very interesting debate. The second stat to watch on the same day is mortgage delinquencies, or how many Americans are falling behind on their mortgage payments. Not a pleasant situation. Thankfully, the answer is not very many right now, just 2.1% of all households in the first quarter, the lowest number since 2006. Now, as US house prices hit record highs and the Fed rate increases push up mortgage costs and inflation forces up food and fuel bills, you could be forgiven for thinking that delinquencies might start to creep up. However, Americans can lock in 30-year mortgages, so the hit from higher rates may take time to filter through and only affect new buyers. But inflation could still put the squeeze on, and indeed so could unemployment for current mortgage holders should joblessness start to rise. Now, back home, there's a still lengthy slate of corporate half-year results or trading updates from a range of large, mid, and small cap firms. Names which may be worthy of further research include the following, although do note that again some of these dates could yet be subject to change. Clarkson and Page Group on Monday the 8th of August. Insurer Legal and General, Aberdeen, Bellway, Intercontinental Hotels, H&T and IWG on the 9th. Two more insurers, Prudential and Admiral, as well as CLS and S&U on the 10th. Entain, M&G, Antofagasta, Coca-Cola HBC, Spirax Sarco and Derwent London on the 11th. And then Flutter Entertainment, the owner of Betfair and Paddy Power, will round off the week on Friday the 12th of August. But it could be another insurer that causes the biggest fuss in the week ahead when Aviva reports its first half figures on Wednesday the 10th. The shares have lost a bit of momentum of late and are almost unchanged on a year ago. As a result of that, the shares are actually no higher than they were in 1992. Chief Executive Amanda Blanc is trying to fix that, but she bore the brunt of shareholder frustration and some frankly unpleasant Neanderthal behaviour at the company's annual general meeting in May. Nor is that the boss's only pressure point, since activist investor Shavian Capital is still on the register. The Anglo-Swedish firm has been pushing Aviva for even deeper cost cuts and greater cash returns than those announced by the FTSE 100 member. Now, Aviva's raised £7.5 billion from the sale of businesses in Poland, Indonesia, France, Hong Kong, Singapore, Vietnam, Turkey and Italy, as Amanda Blanc has elected to focus on the core British, Irish and Canadian operations, as well as Aviva investors. Investors will therefore look for an update on the strategic plan and also comments on the £386 million purchase of Succession Wealth, the UK's largest independent wealth and financial planning business. Any additions to the £4.75 billion in cash returns already made, and a progress update on Aviva's plans to reduce what it calls controllable costs by £400 million between 2018 and 2023. That compares to an original plan of £300 million, but still undershoots Shavian's target of £500 million. After that, attention will switch to the group figures and performance across the operating divisions: workplace pensions, annuities and retirement, commercial insurance, personal insurance, and then the advisor platform. Now, in 2020, insurance sales were hit by the pandemic, but then claims went up and net asset values went down owing to stock market tumbles. 2021 saw some of those trends start to unwind, and in the first quarter of 2022, Aviva unveiled 5% growth in gross written premiums to a new record high, 2% growth in life sales in the UK and Ireland, and £2.7 billion of net inflows at the wealth management operation for good measure. So in terms of the headline numbers for the first half, well, overall last year, Aviva produced an operating profit of £1.1 billion, although analysts have factored in a drop in overall operating profit for 2022, perhaps owing to the Financial Conduct Authority's new rules on pricing, claims cost inflation, and the impact of business disposals. Aviva recorded a solvency ratio of 244% in December, 205% in March. Remember that the solvency ratio measures the ability of an insurer to meet any claims it may encounter. Aviva suggested it will look to use any excess cash beyond 180% solvency ratio by investing in its core business, reducing its debt, and returning cash to shareholders. This explains the cash returns which led to the drop in the solvency ratio this year, although again, Shavian's pushing for more. And Aviva increased its full-year dividend last year by 5% to 22.05 pence. And that included a 5% increase in the interim payment to 7.35p. So that's your benchmark this time around. Note that management has targeted a big increase in the distribution to 31.5p a share for 2022 and 33p for 2023. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.